Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hello, Jim.
REITs have been popular with Canadian investors, real estate trust funds, I guess. But are they still going to be a good deal?
Yeah, so real estate investment trust is the acronym REIT, and they've been on a tear in Canada, as you can imagine, from coming out of the recession, because, as you know, there became a huge inflow of new credit availability into the banking system, courtesy of QE and various stimulus policies, as well as this sort of doubling down on real estate as the savior for the economy after the oil crash. And what we found is that was the fundamental reason in the economy. The cash flow was coming into that sector, but also there was this cohort of people who had, facing low yields and looking for places to go to, quote, outperform. So instead of staying in, government bonds and GICs that were paying very low rates, they sort of migrated more and more capital towards this investment sector. And as the cash flow came in, the, overbuild in that area, we saw it through commercial space, whether it be retail, whether it be office, and just a huge doubling down in building out capacity and buildings and rentals and every kind of real estate across the country. And that happened in America as well. But in Canada, in particular, we haven't got that many investment options in this country other than energy and finance, which makes up almost 70% of our stock market. And so the REITs were an incredibly popular sector for people looking for cash flow and, hoping that we could grow indefinitely in terms of real estate investment. But now all those themes have sort of turned against the sector, and this is the dangerous part, because we saw this in past cycles where, out of the recession and, the stimulus activities from central bankers, people go back to trying to borrow, and that really usually benefits things like real estate. But then when we get to the peak of the cycle, as we did, for example, in 2000, REITs then went on to lose 62% of their value into March of 2009. So these are things that people think of as, it's an income investment. They are even dubbed conservative, dividend-paying instruments by many financial types out there. But I don't think too many people think of losing 60% of your principal as a conservative hold. And many of the people who went in there looking for an alternative to GICs and bonds certainly are not prepared for that kind of a capital hit. While they're trying to collect, at the peak of the cycle, the incomes may be around 5%, but once the shares drop in value, as they did into 2009, we were able to pick them up then with dividend yields north of 8%, and a fraction of the risk. The problem is that in about 2013, this sector peaked out again in terms of cash flows, in terms of just overcapacity, oversupply, overbid, overbought, you name it. It was just crazy valuations again. And indeed, the XRE, which is the Canadian REIT Index Trust, or ETF, it did revisit the same peak that it had reached in March 07 again by about April of 2013. And since then, it's been sort of vacillating but is lower. So we've got a 9% decline from the peak of 2013 to date. 3% of that happened just in the last month on the home capital story, and the concern about the mortgage sector in Canada. So I'm just trying to show people that this is a highly cyclical instrument and caution those who have indiscriminately funneled money there thinking they were getting away with some extra yield the past few years, because they are not holding a guaranteed instrument of any stripe or type. This is a highly volatile sector. And if you think about the themes that have really buoyed the Canadian economy in the past few years, through, the low rate environment and the overbuild and over speculation in real estate, this REIT sector really hasn't got much to hold it or defend it in this environment. So I think that as this story spreads, as the home capital woes become whether or not it's just home capital is really not the issue. This goes far beyond this. This is a cyclical story. This is 8 years since the last meltdown. This is long in the tooth, and it's a credit cycle that has exhausted itself. And so, we should expect to see mean reversion here. Now, mean reversion could be a 50% plus downside, and that's the point which is very often missed. And I think it bears repeating. These REITs will be something one can hold for income again, but not when they're at these nosebleed levels and the capital risk is so high.
What about home equity lenders? Are they risky?
Well, every kind of alternative lender, first of all, let's start with this. Lax lending and poor down payment requirements have meant that people, and the longer this cycle has gone on with excess liquidity, the more debt consumers have taken on and businesses have taken on, even as revenues turned down for businesses in terms of sales, even as income stagnated or fell, consumers really bridged the gap or kept the spending going through debt. So all these lending institutions have had, let's say, a dearth of good investment opportunities and a whole bunch of just throwing, money at consumers and hoping that it keeps the momentum going, sort of thing. And what we've got now is, this kind of a bifurcated group. We have, on the one hand, what you consider the prime lenders, and even many of the prime borrowers who would typically be considered a good bet are finding themselves highly indebted at this stage. So there's a certain concern about how much weakness we could see, defaults we could see on even the prime side here. But then there's the whole class of alternative lenders, which have really been, throwing out money with both hands and feet in this cycle to people who are, self-employed or not able to produce the typical, financial records that the prime lenders have typically required. And so in that environment, everyone's really got out over their skis. They've just, both on the lending side and the borrowing side. Again, it's been a very non-productive chapter because all it's done is bid up prices of assets that have to mean revert back to affordability and connect with income again in the future. So it hasn't really bought us any innovation or advancement other than just asset bubbles which never hold air forever.
We'll have more with Danielle Park right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Danielle Park. Danielle, the future of transportation, big oil, big autos, what's their future?
Well, it's a very exciting story, actually. If anyone wants to accuse me of being pessimistic, they would have to agree that I'm certainly not when it comes to the green energy and transportation evolution that's happening in the world today. My pessimism only comes from the fact that we have really done very destructive policies the past few years in terms of doubling down on debt on debt on debt, which goes nowhere except to write-offs eventually and then asset price mean reversion. But really what the very, the great growth opportunities, the really strong how to get the economy turned around is not always about how to grow faster and faster, which has been the old antiquated model. The other way to improve the standard of living and productivity, which drives good growth in the economy, is to lower expenses, right? To lower waste. And that's really what the future of transportation, because it is such a huge part of the spending of both households as well as, countries, in terms of municipalities, everything, whether it's roads, rail, managing congestion in cities, all the upkeep and maintenance that goes into that. So what we've had in the consumer credit bubble the past few years is they've made it easier and easier for people to buy cars. Now we're going into a phase where transportation is increasingly going to become autonomous, electric, and we're going to need a lot less of it because there's a sharing economy model here as well. So Tony Seba is this sort of energy entrepreneur, keynote speaker person who's, out of Silicon Valley, has been really at the cutting edge of this for the past many years. I've seen his talks before, but he and a colleague recently penned this incredibly interesting study, and I put the link on the website because it is a very visually pleasing document. You can curl up in a chair somewhere and read it. It's called Rethinking Transportation 2020 to 2030, the disruption of transportation and the collapse of the internal combustion vehicle and oil industries. And it really speaks, I think, to the world. It speaks to Canada in particular as we think about how to redesign our future, how to redistribute our economy, and what we can invest in that will increase productivity instead of just throw, more money after old theories and practices. So one of the things that you've noticed, I'm sure, as you're driving around is that in the past decade, all of the main car dealers have built huge showrooms, right? All on the perimeter of cities. They've bought big parcels of land, built very expensive, showy centers where they have all these products on display. Unfortunately, they're all ICE engines. They're all not the kind of transportation people are quickly wanting here. And this is happening much faster than anybody, in the sort of traditional thinking thought possible. We're talking about a technology that is going at hyperspeed change here. All of the main car makers are now, inspired and prodded by Tesla at the leading edge, but they are all now announcing and rolling out their own lines of vehicles, and they are increasingly more cost effective. And, just talking to my own kids about when they get out of university, when they think they might want to buy a car, and whether they're going to need a car loan. And I'm saying to them, in another 5 years, you may find that people are not buying cars. In fact, they are looking for ways to share transportation, and it's going to lower their monthly expenditures, not only on gas, because electric, but also just on the maintenance. There's a fraction of the parts in these cars. And companies like Tesla are making cars for, 1 million miles as their target. They're not working on a planned obsolescence model here. They're talking about thinking of it more as a technological platform that they upgrade through downloads rather than replacing the vehicle every 3 or 4 years. So this is really an entirely new model. It means a lot less waste and friction costs for all factions of the economy, but it also means, a lot less demand for fossil fuels, a lot less demand for big auto, because again, people are going to need a car for a lifetime if they need a car at all, and probably a shared vehicle, or even buses are going, electric autonomous. So this is just upending these major industries that we have all sort of taken for granted as being, a huge benefactors of cash flows in the past, 50 years, and this is not going to be the case going forward. So, all that money that people are talking about throwing into pipelines, for example, wrong technology, wasted money, not what we should be doing. We should be looking at, how cities are going to be transformed by by this. There's going to be all the parking garages that people are spending millions of dollars on. We're not going to need all that space for parking. In the future, downtown cores of cities are very likely to be completely car-free and only autonomous electrical vehicles allowed in them. So we're talking about huge benefits in terms of health and air quality, but also just in a lot less spending for maintenance and repairs. So this is a good thing because it's going to free up cash flow for other things. And this report goes in detail at, if households are not having to spend, 20% of their income on just their transportation needs, that means they are going to have more cash flow for other things. So in a world where incomes, you're looking at deflation, we're probably looking at slower growth as the world ages here. The good news is we can continue to improve standards of living, not by necessarily rapidly increasing sales as the old model, but by improving efficiency, productivity, and getting more bang for the buck.
We'll have more with Danielle Park right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Danielle Park. Danielle, the Scotiabank slogan is, "You're richer than you think." Are people really richer than they think?
Yeah, so that's a personal peeve I've had, and they've kept it for many years now. I'm thinking they ought to find a new slogan going into this new era where consumers are getting out of debt instead of piling it on. But it's just a rationale for the banks to keep people believing in this dream that you can borrow your way to prosperity, that you can buy a bunch of risk junk that pays them tons of fees and somehow become a millionaire in the process. That article that I posted this week, Canada's Middle Class is on the Brink of Ruin, it's a very detailed look at Canadian households and how much debt, how we are the most indebted of any G7 nation today, and that it is very troubling looking at the next decade, say, of how households are going to be able to repay what they've borrowed, what losses and write-downs are inevitable, how that's going to impact the housing market and the lenders and the finance sector, and how it's going to reduce the spending that is available for, many other things that we're kind of, the economy is banking on. So it's a good look. I think it goes into a lot of stories about individual families and how they got into such hock, so to speak. It's a toxic soup of many things. Some of it is just, life has bad luck in it. Things happen to health or, marriages, things. That's always been the case. But when people are as highly indebted as they are today, they have very little buffer built in. They have no sort of safety zone, margin of safety to go to. So, it's that access to easy credit. It's the risk sellers handing out all this high stakes, risky products and calling it financial advice. It's the, relentless marketing about what you need as lifestyle, coupled with poor wage gains in the West because of all the globalization and offshoring, and then a general lack of personal discipline for individuals who, aspire to a certain level of spending that they literally don't have the money for. So it's all those things together, and I say it's an important story to read and appreciate, and do so with empathy by all means, because, humans, no one likes to see someone set up for financial failure because it has very serious repercussions. But at the other side of this story, I think, is what people are missing. The people that there's the haves and the have-nots, right? The haves, have-nots have lots of debt, but not a lot of equity, not a lot of savings or cash. But the so-called haves in our society today also don't have a lot of liquid cash. What they have typically is a lot of real estate, which, as I say, is overvalued and vulnerable to a decline here, and a lot of financial assets, which they've been sold as, what you do with your savings. Well, what if those financial assets are also on the other, they were inflated by this debt bubble. All the consumption that can't be continued, all the sectors that have benefited from the, dumbing up, the debt dumbing that we've all gone through are now going to have to mean revert back to either go right out of business or become completely transformed into a whole new business model. So we're in this mean reversion phase, and that means the debt's going to go down, but also the spending's going to go down, and also the asset values that have been billowed on this credit bubble have to mean revert. So my point would be that, now is the time for people to realize that connection between the haves and the have-nots, and realize that the people who have debt that can't be repaid, they end up losing their debt. That's what they end up losing. They go bankrupt, right? We don't have debtors' prisons. We don't, enslave people who can't repay money they've borrowed. We just write it off ultimately, and, hopefully they learn their lesson and they go back to trying to rebuild their life. But it's the people holding those financial assets who are very mostly near the end of their working career, already retired, that are probably not prepared for the fact that they too have something to lose here, and that something is asset value and net worth on their balance sheet. So that I think they have to really try and get the connection here. The reason asset values got so high was this abuse and reckless treatment of debt and leverage in the world. As that debt and leverage works down, implodes, is written off, asset values will also have to work lower.
Danielle, on something positive, people wonder, where can we put solar panels and not interfere with property and highways and so on? Someone has come up with a brilliant solution. Why not put solar panels on top of water?
Yep, there is so many different. I went to an open house on the weekend just north of Toronto for bone structure, and at the open house there were many people who are consultants and experts in the whole gambit of alternate energy technologies and approaches, and basically they do a property specific assessment for you based on, where your house is, where it sits on the lot, what kind of needs you have for consumption, as well as what, light exposure you have. And there is all kinds of different solutions, whether they are, solar panels standing on end, whether they are, tiles, whether they are solar arrays in the yard, whether they are floating on water bodies. I mean, there's every week, literally, new things are coming out and new applications. So I think that it behooves people, this is the future. This is going to save a ton of money. It's going to be a lot more cost effective. So, anyone that's had any thoughts about this in the past, or maybe did research or looked into it, 5 years ago, entirely different set of solutions and opportunities now. So I think it's great if you can hook up with one of the consulting companies that is on the cutting edge of this stuff. You send them your hydro bill, and they look at your roof from, Skycam, and basically it starts there, and they can give you, here's what would work in that application, here's the cost, here's the payback. It's all pretty exciting stuff, and this, the technological stuff is literally something you read last month is out of date by this month. That's the speed at which this is going, but it is all incredibly helpful and coming exactly as the world needs it, so it's great.
Danielle, thank you so much for chatting with us.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.